Welcome back, Personal Finance Gang. This is our last presentation of the semester, and this will wrap up our talks on retirement plan options. Last time I mentioned defined contribution and defined benefit plans, and we said that defined benefit plans are kind of going the way of dinosaurs, disappearing, and what you'll most likely get when you go to work at your employer is a defined contribution plan where the company promises to make some payments into the plan, but the outcome from those payments is not guaranteed. All they're guaranteeing is they're making some payments now. And so what you'll likely have as retirement plan options are either a 401k plan or a 403b plan. Basically, they're the same thing, except a 401k plan is offered at for-profit companies, and a 403b plan is offered by not-for-profits. So when I worked in the corporate world, I was in a 401k plans, and at the university, I'm in a 403b plan. But everything else about the plans, I don't know why they have to have separate numbers, but everything else about them is identical. Just for the most part, as far as I can tell. Now, with both of these plans, the way they generally work, there are actually some alternatives here, but what generally happens is you sign up with your employer and agree to how much you're going to contribute to the plans. Money comes directly out of your paycheck and goes directly into your retirement plan. So I get a paycheck this Friday, so some money will be held from my paycheck, and it will go directly into my retirement plan. And I'll be able to see the contribution in the retirement plan most likely this weekend. A nice thing about that, so I have money put directly into that account, it reduces my taxable income. So suppose I was made $4,000 this paycheck, and if I put $1,000 into my retirement plan, that would mean that I would only be taxed on $3,000 and not the $4,000 I earned. Actually, there's limits on your contribution amounts and such, but we're not going to worry too much about that. So the contributions that you make lower your taxable income, which makes it feel like you're not really contributing or not as much as being withheld, because you do get that tax benefit. So anyway, I'll have an example of this coming up. But anyway, back to that, you reduce your taxable income. Now, and then as you make money in the account, remember with a regular mutual fund, you might have capital gains distributions, dividend distributions, you might make capital gains, etc. None of that is taxed as it's in the account. So I contributed to my first 401k plan back before most of you were born in 1984, I think. Yeah, so 1984, I was in my first 401k plan, and I have not paid taxes on that money, any of that money yet. The money I earned that year that went into the plan, not been taxed. The earnings I made since 1984 have not been taxed. It's not all roses, though. What will happen is when I take money out of my retirement accounts, that's when I'll be taxed. But remember back to when we talked about taxes, everything else equal, we'd like to avoid paying taxes legally. If we can't avoid them, postpone them. And heck, I've been postponing some income taxes since 1985. But everything I take out, plus including gains and my original contributions, will be taxed as ordinary income when I take them out. But again, for some of the money, that'll be a long, long delay. Now let's do an example here. Suppose your net paycheck is currently $30,000. So this is after taxes right now. You make $30,000 for the year. And you plan to put $2,000 into your 401k plan. You are in the 25% federal marginal tax bracket. You're in Florida, you don't pay any state income tax. What is the impact on your net pay? So right now your net pay is $30,000 per year. If you reduce your paycheck by $2,000, how much will it go down? Or not if you reduce it by $2,000, but if you put $2,000 into your 401k plan, how much will your paycheck go down by? It's actually only going to drop by $1,500, because what you'll see is that putting this $2,000 in lowers your taxable income by $2,000, saves you $500 in taxes this year. So you put $2,000 in, your paycheck only goes down by $1,500. So you don't feel the full pain of the contributions because you get an immediate tax savings. Really nice benefit there. Okay, and this is one of the things I've liked about these plans. There's some other options here with 401k or 403b. So there's a Roth 401k, Roth 403b. Is with the Roth account, and then we'll talk about Roth IRAs too. They do work the same way. With a Roth 401k, you get no tax break now. No tax break at all when you put your money in. So back to this, if you were putting into a Roth 401k instead of a regular 401k plan, put $2,000 in, your pay would go down. Your net pay would go down by $2,000 because there's no tax break today. So why not take the tax break today? Well, with a Roth, once you put the money in, your earnings grow tax-free. So you could put money in now and leave the money in there for 45 years, no taxes on any of the earnings, and no tax when you take your money out. That's very nice. So if income tax rates go up or whatever when you retire, you don't pay them. As long as the government doesn't change the rules on this, which not 100% guaranteed, but would be kind of sleazy if they did. But anyway, so Roth accounts, no tax break now, earnings grow tax-free, but everything you take out, as long as you meet certain rules, got to keep the account open for at least 5 years and make your withdrawals after age 59 and a half. There will be no tax on these. If you are in a low tax bracket now, this is particularly attractive. So this is a really, really good deal if you're in a low tax bracket now. So if you're not going to, let's say you aren't going to owe any income tax this year, you would get no tax break from a regular 401k, so definitely do the Roth. If you're in a really low tax bracket this year, you're only going to get a minimal tax break on this. Go ahead and do this, and you'll save when you take the money out later. Where the regular, backing up, where the regular 401k pays off, I missed it. Where the regular 401k really pays off is if you're in a high tax bracket now, hey, take the tax savings now. You can do a mix of these, get some tax savings now, worry about paying your tax later, and then do a Roth, get no tax savings now, and get a tax break later on. So a mix of those might even be good. But you need to know the difference between a Roth 401k, this is same for the 403b, and a regular 401k or 403b. We'll see the same thing when we get to IRAs. There are regular IRAs and then Roth IRAs as well. What's an IRA? Well, that's coming up. With most 401k and 403b plans, I touched on this already, employers offer some form of matching. And so even if you're going, geez, I can't afford to save for retirement now, if your employer is going to match funds, you've got to figure out a way to get that free money. So I worked for 2 employers. If I put in up to 6% of my pay, they would match that 50 cents on the dollar. And where else are you going to get a guaranteed immediate 50% return? You've pretty much got to take advantage of that. So you should be saving at least 10%, but given, if you can't do that, you've got to do whatever it takes to get the full match. So when I said I put money into one of these accounts in like 1985, I was not stupidly putting in 10%, but what I did do was put in 6% because I got a 50% match on that. So my employer and I combined were putting in 9% of my pay, which would have been better to have me putting in 10 and the employer putting in 3, obviously. And the compounding on that over all these years. Anyway, I sure wished I'd done that back then, because it would show up in my retirement accounts today. The money, the extra you put in now, you're like, well, geez, that's not that much. But if you think about 40, 45 years of compounding at a decent return, it really adds up. But back to this, matching, a term you want to know. Definitely take advantage of any matching you have with your employer. And this is one of the things you do want to know about their retirement account. Do they have any kind of matching? Now with these accounts, with all these nice 401k, 403b, Roth 401k, Roth 403b, and we'll see this with IRAs, etc. coming up, you're going to be in charge of deciding where your money goes. With the 401k and 403b plans, there'll likely be a limited number of options where you can put your money. So here's some choices. Where do you want to put your money? So typical choices you'll see in 401k plans or 403b plans would be a basic money market mutual fund, low risk, low return, not a good choice for the bulk of your retirement money unless you're, not even when you're real close necessarily to retirement. There'll be at least a stock fund. Again, depending on your company, you may have more or less choices. Bond funds, we know about stocks. If you buy stock, you're a part owner of the company. If you buy bond fund, you're lending money. Stock has higher risk, higher expected return, but not guaranteed. Bonds, lower risk, lower expected returns. As you get closer and closer to retirement, you might move more of your allocation towards bonds. If you work at a publicly traded company, odds are that they'll have a company stock fund in the mix. And for 2 of my corporate employers, this is where they put their matching funds, was in company stock. So if your employer's putting their your matching funds in company stock, and you have the option to put some of your money in company stock, should you? Probably not. Diversification. If you've already got a sizable chunk of your retirement going into company stock, diversify the rest. One of the famous examples of this was Enron. This was a super big, it got to be like the 7th largest company by market capitalization in the U.S. at one point. And the company stock was doing great, so the company put its contributions of retirement dollars in company stock, and then employees said, boy, the stock's doing so great, I'm going to put my money in company stock as well. Well, when the whole company ended up being a scam and went belly up, people lost all of their retirement. What they should have lost is just the employer's part of the contribution, because diversification, don't put all your eggs in one basket. So they were working there, they had all their retirement in the company stock, and when the company went belly up, they lost their jobs and their retirements. Anyway, so if your company puts some funds in there, that's probably enough of your portfolio to be in there. Put the rest of your choices in stock and bonds, most likely. Stock predominantly as you're younger. If If you're going, hey, this is giving me a headache, I don't like it, I don't like having to make these choices. A lot of companies now have target retirement date funds, and we talked about these. So you just skip the hassles, skip the worries, just put your money in a target 2065 retirement fund. Right now, that'll probably be mostly stock, some bonds, and that weighting will change over time as you get closer and closer to retirement. You don't have to mess with it. The managers of the fund are going to periodically rebalance that. Some places may have some guaranteed contracts, generally at lower returns and such. You can look into those, but this would be my bet. Different companies are going to have different allocations. Don't lose too much sleep over it. If go with one of these nice things. They're going to be relatively high risk, so there will be ups and downs in the next 40, 45 years. This is your waiting till 2065 or whatever date you pick. But just stay the course over the long run is what you want to do with these. But back to this again, you're going to pick where the company puts the money. Used to be the default was money market accounts if you didn't pick, and some employers may still have that, but now many places are putting, hey, if you don't pick, they pick the target retirement date that they think fits you best. And this is because once people open the account and it just goes to money market, they don't change it. And we've had people earning 0.1% a year for 10 years. Meanwhile, the stock market's doubled and doubled, So, and then crashed now, but still way above what you'd been made with the money market if you'd been investing over the last 10 years. So you will have choices. You must pick where your money goes. Company may offer you some help, but you're still going to pick. If your choice goes wrong, you put in the money market and you go, geez, I didn't know that 0.1% a year over 40 years, I would only end up with 1% more than I started. Well, that's too bad. The company's just guaranteeing they made contributions. Disadvantages to the 401k and 403b plans. Most companies are going to give you a limited set of options. So you might like, hey, I like those Vanguard funds. They may not be an option in your plan. Or if you like, I'd like to be able to buy individual stock. That may not be an option in your plan. So you're going to have to make the choices, but they're going to be limited to the options that your employer gives to you. Now, there are ways to get your money out of this, but you don't want to. So any money you put in here, you should assume is locked up until retirement. Again, there are some ways to get it out. You can do that. You don't want to do those. We'll mention, I think, one of those coming up. You can also borrow against these. You don't want to do that most likely either. But just think of this as money that's tied up until retirement and forget about it. Other than it's growing there, it's going to be there way down the road. Don't even think about touching it for the most part. Just it's there locked up till age 59 and a half. Don't ask me why it's a half. But it's locked up until then. If you get it out earlier, it's going to cost you. Then the other side, this for most people won't be an issue. You have to start withdrawing money from these plans by age 70 and a half. Why does the government want you to start taking money out? Well, they want to start taxing you, and there'll be minimum withdrawal amounts that you have to make. You don't have to spend the money. They just want to collect the tax dollars. So that's another downside. You don't plan on taking it out till you retire. Must start taking it out, must start getting taxed on these regular plans. Then there are also caps on the contributions. We're not going to get into those. Those will be changing over time. But if you're for most people starting out, they're not going to be an issue. Down the road, they may be an issue, and you may go to some alternative plans, alternative things like deferred compensation plans and such, and then maybe other plans to postpone taxes. But you're going to be they're not going to be an issue for most people right off, so we're not going to worry with them. Now, most people don't stay at the same employer for 30 or 40 years anymore. People end up changing jobs and moving on. So you're worried about, hey, I've been putting money in this plan. What happens to that? Remember, any money you put in, any contributions you make are always 100% yours. So if you contribute some money this Friday and leave next week, that money goes with you. That money is yours. We'll talk about whether it goes with you or not. But that money is always yours. Your employer contributions, it depends on vesting. So that was a term that you need to remember to know what it means. Your contributions may or may not be eligible to take those depending on the vesting rules of your company. So at the university, we're 100% fully vested immediately. So if I get money put in my account this Friday and leave on Monday, the university contributions are mine as well. Some employers, maybe you have to work there X number of years and then you're fully vested. So that's to encourage people to not, hop around. So you come and stay 2 years and leave, your contributions go with you. Your employer contributions may or may not. And the nice thing about your contributions going with you, and the reason you want to start this type of account is, in the old days, people might go and work for the same employer for 30 years and have that nice defined benefit plan, versus if you jumped around from company to company, you'd end up with no retirement under those old plans. Anyway, so if you quit, don't worry, the money's not lost. Can you get the money sent to you? So you quit. One option you have is, hey, I just want my 401k money, give me the cash. If you do that, you owe income tax and a 10% penalty. So back to where I had that age 59 and a half, just don't get the money spent to you. Don't do that, because it'll kill your retirement savings. It's not going to compound anymore. Ordinary income tax and a 10% penalty. So what should you do if you quit? Well, you have two choices. Some employers will let you leave your money in their accounts. I probably wouldn't even do that unless the account was super wonderful or whatever. What you can do instead is roll that money over into an individual retirement account. So a rollover IRA. There's no limits to the money you can roll over. So say you've been working someplace 10 years. What you can do is roll that over into an IRA account that you set up at an employer. So big advantage to that. You had limited funds at your employer option. You can roll it over into an IRA and you basically got unlimited investment options. So you pick the financial company that you want your money at, and I picked Vanguard that I mentioned before. So my rollover IRAs are at Vanguard. So I've rolled money over from a couple different employers. All that money is at one location where I can make all the choices I want there. Anyway, so that's a nice thing, is a rollover IRA. They're easy to set up. A little bit of hassle getting the paperwork and all, get the money transferred isn't always instantaneous, but once you get it there, it's there. You can keep track of it and put it in your favorite location. If you're self-employed, we talked about 401k and 403b for employers. Self-employed people have what's known as Keogh plans, basically do the same thing here, but allows you to make contributions based up for you and your employer, so you get a little bit of extra there. Benefits potential with these. We're not going to go into those though. Now, these are some options here, not through your employer. Self-directed retirement accounts or individual retirement accounts. That's what IRA stands for. We've got 3 different choices here: a deductible IRA, a non-deductible IRA, and a Roth IRA. Right now for 2019 and 2020, as far as I know, this hasn't changed or won't be changing for the this year. And the contribution limits for IRAs are $6,000. This is total amount you can put into IRAs. You can put in more into the 401ks and 403bs. So that's kind of a disadvantage with these if you're not going through a company-sponsored plan. But $6,000 is the max contribution, or if you're over 50, you can put in $7,000 per year basically right now. And these amounts are going to adjust up with inflation. So they had them fixed for a while, a long while, which didn't make any sense. Excuse me again. So I say max you can put in is $6,000 or $7,000 if you're older than 50, but you can't put in more than your earned income. So if you only made $5,000 from working at your job this year, you can't put in $6,000. The most you could put in would be $5,000 you earned. You don't have to put your money all in one location. I think it would be nice just to do that, to keep it simple. But you can't, it's not $6,000 per IRA account. So you could open 7 different IRAs for the year, but the total contribution couldn't be more than $6,000. So I would just pick your favorite location. Again, I put mine at Vanguard because I like low costs for their funds and ETFs and stuff. And mine set up a brokerage account. I can buy stock and bonds, and etc. ETFs, all sorts of options. Target retirement date funds, whatever. But these are the max contributions right now. And your spouse, even a non-working spouse, can contribute, have their own IRA as well. So there's a limit to the not more than earned income. A non-working spouse can contribute as well. So I've said this already. Where can you open an IRA? Pretty much any financial institution. I don't get anything from Vanguard. I like Vanguard though because it's low cost. If there's a place where you like some of the services they have, you can go there. But like Vanguard mutual funds or ETFs, you can buy ETFs anywhere now. So pick your place you like. Look at the minimum amounts to open an account, etc. And most of them don't really have high minimums for IRAs, maybe $1,000. But pick your financial institution and just start putting money there. If you don't know what to do, do a target retirement date fund. So where can you invest? IRA funds. Pretty much any financial security you can buy with these. That doesn't mean you should, but you can. So target retirement date funds are a nice option. Stocks, bonds, etc. So I've owned different individual companies in my IRA before. Different mutual funds. So you can buy, I didn't put ETFs on the list, but mutual funds or ETFs. You can buy other things here, but you can't buy art, baseball collections, stuff like that, coin collections. But any of the financial securities, there are ways to get real estate, but I don't know that I'd get that fancy. We talked about real estate investment trusts before. You could do commercial real estate through something like that. So practically unlimited choices for your IRA, but some of these are extremely risky. You could, if you picked an individual stock and put all your money in it, it bombed, well, that would be your total retirement bombing. So remember diversification. Don't put all your eggs in one basket. So how do you get into a deductible IRA? This is the one, a deductible IRA, you get a tax break now. I'll show this coming up. And then just like the regular 401k, 403b, if you don't have a retirement plan at work, you're eligible for deductible IRA. There are some income limit maximums that aren't going to affect most of you right away for deductible IRAs and Roth IRAs. So you got to check on eligibility, but most people will be eligible even if they have a retirement plan at work for a Roth IRA. And anyone can open a non-deductible IRA. With that, you don't get a tax break now your earnings grow tax-free, and then you're taxed at retirement. So it's not as good as the deductible IRA. But with a deductible IRA, tax break now, just like we talked with with a regular 401k or 403b, the money you put into a deductible IRA lowers your taxable income this year, means less taxes this year. Then your earnings grow tax-free, and you are taxed on everything that you take out at retirement. If you wait till after age 59 and a half, you just pay ordinary income tax on all the money you take out. So nice deal there. You can probably open up one of these right now, but if you're in low income right now, this isn't what I'd suggest. A non-deductible IRA, no tax break now. Yeah, so no benefit now. Earnings grow tax-free. Earnings taxed when withdrawn. So definitely, it's not as good a deal as this. There's as the deductible IRA, no tax break now. So I'm not as fond of these. You can actually defer taxes on a lot of investments just by not selling them. So you could put your money in a regular stock fund or stock ETF. You might get some dividend or some capital gains distributions and such, and dividends distributions. But then some of that money you can be taxed as capital gains later on, which might be a better deal than this one. So it's not super fond of that. Now, with a Roth IRA, again, we saw the Roth 401k, 403b. If you're in a low tax bracket now, you're a student, you go, geez, I do want to set aside some money right now for retirement, and I'm willing to lock it up basically till you retire. These are a great idea. You're just starting out working, your employer doesn't have a plan, or you want to do some extra. No tax break now, but if you're in a low tax bracket, that's not going to matter that much. A low or no tax bracket, it's definitely, with no tax is due this year, it's definitely not going to matter that you missed the tax break. So no tax break now. Earnings grow tax-free. You're taxed when you're withdrawn. So this is something we gave my daughter 1 year more. Said, here's some money for your Roth IRA. So she didn't get a tax break that year because she didn't owe any taxes. We had to put in less than what she earned. But that money's going to grow tax-free until she withdraws. Well, going to grow tax-free forever. And as long as she keeps the account open for 5 years and takes that money out after age 59 and a half, no taxes on this at all. So your money could double and double and double. So if you put money in the stock market and it doubles every 7 years, and you leave your money in for 49 years, you've got 7 doubles in there for the initial contributions, and none of that's taxed when it comes out. So if you're in a low or no tax bracket, or just want to diversify your tax situation, really good deal with these. A nice thing with them as well is the money you put in, so let's say you put in $6,000 this year, you can actually take that $6,000 out at any time without penalty. You don't want to, but you could. So only the penalty comes in, for early withdrawal of the earnings. But since your initial contributions were already taxed, you can take them out without penalty. Any earnings that you make in your fund, your account, if you take those out, you get ordinary income tax, or you get a nice 10% penalty there. So don't take those out before retirement if at all possible. So again, any of these retirement plans, think of the money you put in as locked up until you retire, and you'll be better off. There are ways to get them out early, but you don't want to. You lose your compounding, and you get penalties tossed in as well. So that's all. There's a lot more to, there's estate planning and other things you could do, but we're just hitting basically these 3 plans: 401ks, 403bs. These are just, those are the same thing, just are you at a for-profit or not-for-profit? And these are company-sponsored plans. They have tax advantages. Then you've got individual retirement accounts. You open these on your own through your financial institution of your choice. Got tax advantages with these. We've got the Roth plans, versions of all these where there's no tax break now, no taxes at all when you leave the money in till retirement and take it out. So no taxes when you take it out. With the regular plans, you get a tax break now, you get taxed later on. If your employer offers a matching, definitely take that matching. You can't leave free money laying around. Remember, best thing to do is start putting in money with your very first paycheck, and you'll never miss it. You go, I can't afford it. You can't afford not to do this when you're looking long term, because you get a tax break now, and it's going to compound, and it's going to, small amounts now will look bigger over time. If all this gives you a headache deciding where to put your money, just do a target retirement date fund. Odds are you'll have a target 2065 choice. Different plans will have different mixes of assets in there. Giving you a headache, just pick one of those. All right, so that's all for this topic, and that's all for the semester. Sorry we weren't in class for the last of this, but it is what it is. So start saving as soon as you can. Remember, the time value of money is your friend if you start saving early, and be safe.